Welcome to lecture 22 of corporate finance. In this video, we are going to discuss stock dividend and stock split. So moving towards the contents, previously we have discussed what dividend is. Then we discussed different theories regarding dividend. And then we saw that what is meant by stock repurchase, stock dividend, and stock split. This is what we have done. In this video, we are going to first understand what is stock reverse split. It is somewhat related to stock split, but it is opposite of stock split. So you would have possibly got an idea of what it is, but we would discuss this in detail. Then we would solve certain numerical example regarding these other topics that we have covered. Okay, so what is reverse split? A stock split in which a firm's number of shares outstanding is reduced. If you recall stock split, then what stock split was is that it increases the number of shares of the firm or shares outstanding. For example, if we say 3-to-1 stock split, then it would mean that any shareholder holding one old share would now receive 3 new shares. So any shareholder previously holding 1 share would now have 3 total shares. So obviously when that would happen, the number of outstanding shares would increase. And we have discussed multiple reasons that why this happens, why companies go for stock split. Remember, when number of shares would increase, then each share price would decrease, right? Okay, this was stock split. But coming back to reverse split, in reverse split, what would happen is the opposite of this specific scenario. Say, for example, the company would say 1-to-3 reverse split, or even it is also called stock split, but it would be 1-to-3. So in this case, what would happen is that any shareholder previously holding 3 shares would now have only 1 share, right? So if a shareholder was previously holding 3 shares of Fauji Fertilizer Corporation, then after the reverse split, the shareholder would be left with 100 shares of Fauji Fertilizer Corporation. So in stock split, the number of shares would increase, but in reverse split, the shares outstanding or number of shares will decrease, right? When number of shares would decrease, its price would increase, right? So for example, if previously 1 share was say for example for 30 rupees, then after reverse split, its share price would increase to say 90 rupees per share, right? So the increase would approximately, or the decrease in the case of stock split would approximately be the same number of times as would be the reverse split or the stock split. So in this case, the stock is the number of shares are reducing by 3 times. So the share price would approximately increase 3-folds. Okay, so let's discuss certain scenarios. This is another example. 1 for 10 reverse split would mean any shareholder holding 10 shares previously would now be left with 1 share. The number of shares for shareholder decreasing means that the number of outstanding shares for the firm would also decrease. Okay, so what are the reasons for stock split? First one is our transaction cost to shareholder may be less after reverse split. So what do we mean by transaction cost? Whenever we buy a single share, we are subject to different costs. For example, there are certain duties, certain taxes that are levied on us, but the most important of these costs is broker commission, right? So normally the commission would either be in certain paisas or a percentage of the share price. So let's just say if one share would cost, just say, 6 paisas to purchase, right? And previously if we wanted to purchase 300 shares, and if its price was 30, then that would mean that it would cost us 9,000 rupees. Okay, this would be our investment. So previously if the share price was 30, the broker commission for per share would be 6 paisas. So 6 paisas multiplied by 300 would give us the number of paisas that we would have to pay. But now instead, if the number of shares are reduced after reverse split, for same investment for this, so the price would also increase. Say for example, now the price is 90. So for same investment, we can only buy 100 shares. So if again the commission is 6 paisas, then you would immediately know that the transaction cost was higher previously, and after reverse split the transaction cost would reduce, because previously you had to pay 6 paisas for 300 shares. Now you have to pay 6 paisas for 100 shares each. So transaction cost to shareholder may be less after reverse split, one of the reason. Second is liquidity is improved because the share is raised to popular trading range. Okay, so there is a terminology which is called penny stocks. This penny stock terminology is used for small stocks, right? So in US, normally any stock less than $1 would be called, say for example, penny stock. In Pakistan, we can say that any stock less than 10 rupees, say, can be called, or even 15 rupees can be called a penny stock. So there is no exact definition, but the idea is that these stocks have quite small price. So sometimes these small stocks are considered unfavorable by investors, and therefore their volume or trading is quite low. So what the company would want is to improve it. Say for example, currently a share, or I guess DCL share, it's for around 1 rupees. Say for example, KE Electric, its price is around 3 rupees, right? So besides the transaction cost, these shares are at quite low prices. So what the company would want is to increase its prices. So to increase, what they can do is they can go for reverse split, and its price would increase Second, stock selling at prices below a certain level are not considered respectable. So I just gave the example here. So those stocks that are selling at quite low price are generally considered not respectable among the shareholders. Their price is low for certain reason, obviously. So next one is stock exchange have minimum price per share requirement. So there are certain stock exchanges that do have certain requirements that a share should have a price of at least say for example in Nasdaq they have a $1 minimum price for 30 days. So any share that drops below $1 for 30 days continuously, then it would be delisted from Nasdaq Stock Exchange, New York Stock Exchange. So there are certain stock exchanges that do have this kind of requirement, and in that case, for that specific company's share to increase its price, what the company can do is they can go for reverse split. Okay, so let's move towards some examples, some numerical examples. So first one is regarding ex-dividend. If you remember from our discussion on ex-dividend, it was a 2 days, a date, two working days before the record date, or the date on which the stock becomes ex-dividend. Previously the stock is come dividend. In Pakistan we have a 1 day window before the record date. Okay, so ABC Corporation has declared a $4.60 per share of dividend. Suppose the capital gain are not taxed. This is irrelevant in this case, but remember that dividend are taxed at 15%. So the share of ABC Corporation is currently selling for $80.37 per share, and the stock is about to go ex-dividend. What do you think the ex-dividend price would be? So what this means is that when the stock is come dividend, that means it do have a dividend, then its price is higher, and as soon as it becomes ex-dividend, that is the dividend is deducted from it, or and the date on which the holder of that stock would receive the dividend, the ex-date dividend, its price would decrease. So in this question we need to figure out how much the decrease in price would be. For that we first need to calculate after tax dividend, and because the dividend is 4.6%, its tax rate is 15%. By the way, in Pakistan, tax rate is also 15% on dividend for filers, and it's 30% for non-filers. Okay, so if this dividend is 4.6%, then we need to find out the price per the dividend per share after deducting tax. So that would become after tax dividend. So this would be 1 minus 0.15, and we would have 3.91. So this amount would be the after tax dividend. We would receive this amount after deduction of dividend. Now we need to calculate the ex-dividend price. And this would be the share price. Okay, so the idea is that the share price would decrease by the amount of dividend on the ex-dividend date. So it would decrease by 3.91, and approximately its price on the ex-dividend date would be 76.46. Remember, in previous slides or previous lectures, when we were discussing this idea of ex-dividend, we didn't explore the idea of tax, right? In that example we said that if a stock is being sold for $10 and a $1 dividend is declared, then on X dividend date, its price would become $9, right? This $1 dividend, its price would reduce by the amount of dividend. In that lecture, we didn't discuss the idea of tax, but normally what would happen is its price would decrease, not exactly by the amount of dividend, but by after tax dividend, right? So this should be adjusted for after tax dividend. So after tax amount would be around 85. So the price would decrease to around 9.15 approximately. So this is approximate price decrease. This is what we would expect. Okay, next question is regarding stock dividend. The owner's equity account of this quadrangle international firm is shown below. So we have this owner's equity account. The question is that if the stock is currently selling for $30 per share and a 10% stock dividend is declared, how many new shares will be distributed? Show how the equity account would change. So first we need to find out how many new shares will be distributed, and then we need to see how this equity account would change. Okay, so remember stock dividend. By stock dividend we mean that the number of shares outstanding of the firm will increase, right? So what we need to find is new shares outstanding, and that would be, so previously, so the formula would be old number of shares outstanding multiplied by 1 plus the stock dividend percentage, right? This would be the formula. How do we know the number of shares? The number of shares are not given in this question, but we know that if $1 is the par value and the equity account is showing $30,000, then we immediately know that there are 30,000 shares outstanding previously. Then the stock dividend percentage is 10%, so it would be 0.10. The answer would be 33,000. So the new shares outstanding, or the total shares outstanding after stock dividend, would be 33,000. Previously it was 30,000. So obviously the difference between this amount would be the increase in shares outstanding, right? So how many new shares would be distributed? The 3,000 new shares would be distributed. Next, we need to understand what would be its effect on the this equity account. So remember, in equity account, we would draw a new account. So common shares, the par value would remain same. So we would say common stock, and the par value is $1. But now instead of multiplying it with 30,000 shares, we need to multiply it by the total new shares. That would be 33,000. Next would be the capital surplus. So previously we had 285,000 capital surplus. Now 3,000 new shares are issued, and each share price is $30, but one is par value, so the remaining excess capital is 29. So this $1 is already recorded. The simple idea is that it is already recorded in common stock, so the excess amount is 29. So we multiply 3,000 by 29. Whatever amount we get, we add it to this old capital surplus, and the total amount would be 372,000. So this would be the amount that we would record in the new capital account. Then we have retained earning. So retained earning would adjust. The total owner's equity would remain same. Remember, the stock dividend or stock split would not affect the total owner's equity. It would remain same. This retained earning would adjust, and now the retained earning would be this amount. So how did we came by retained earning? This total equity amount minus 33,000 minus 3,72,000. So we are left with this amount of retained earning. Okay. The next question is that if the quadrangle declared a 25% stock dividend, how would the account change? Now, instead of 10%, if imagine that this stock dividend is 25%, what would be the total number of new shares distributed, and how would the equity account change? So you need to solve this whole question using 25% stock dividend. So I leave this part to you to practice. Okay, then we have stock split. So imagine that quadrangle declares a 4-to-1 stock split. How many new shares outstanding would be there now? So if previously there were 30,000 shares, again, how do we know 30,000? If $1 is the par value and the total amount is 30,000, so obviously there are 30,000 shares. For each new share, the shareholder would get $1. So this is the ratio 4-to-1. So we multiply this ratio by 30,000 and we get 1,20,000. So the total shares, this isn't asking about new shares, this is asking about how many shares are now outstanding. So now instead of 30,000, total shares outstanding are 1,20,000. Next is what would be the new par value. Remember, the par value would also adjust. So if previously par value was $1, now it would adjust in this ratio, the reciprocal of the stock split ratio, and now the par value would be 0.25 per share. So remember, in case of stock split, this all amount would remain exactly same except this par value. So now what you need to do is calculate. So this par value would be 0.25 multiplied by total new number of shares. So we would again have 30,000. All the other amounts would remain same except for the par value. Just the par value would change. The second part is I would recommend that you go through it yourself. So instead of 4-to-1, it is saying that 1-to-5 reverse stock split would happen, right? So everything would be same, but just you need to multiply or divide it using this new ratio. Okay, so Red Rock Corporation currently has 350,000 shares of stock outstanding that sells for $90 per share. Assuming no market imperfection exists, that is, there is no tax, there is no transaction cost, what will be the share price and share outstanding? So we need to calculate share price and share outstanding if there is 5-to-3 stock split. So we have share price and we have shares outstanding, right? So in this case, the share price would be 90 into, when we need to calculate the price, remember we need to take the reciprocal of this stock split ratio. This would be 3-to-5. So the new share price would approximately be 54. Number of shares outstanding. So we previously had 350,000 shares. For shares, we need to take this same ratio, that would be 5/3, and now we have 58 number of shares. Similarly, if the company, instead of having this case, the second case happens, that is 15% stock dividend, then the share price would be 90 into 1 divided by 1.15, that would be 78.2, and the shares outstanding would be 3,50,000 into 1.15, because it is 15% stock dividend. So the total share outstanding would become 4,25,000. 2,500, sorry. Next case also similar. So you exactly need to mimic this process. I'm just going to give you the answer so that you can compare it with yours. And the shares outstanding would be 498750. Next we have 4-to-7 reverse split. So instead of stock split, we would have reverse split. The idea is still similar. So previously, if we had 90 price, so this would be reciprocal of this. For share price, we need to take reciprocal. So now remember, in case of reverse stock split, the share price would increase. We would have 157.5, and the number of shares outstanding would decrease. So if previously we had 3,50,000 shares, this would be 7 by 4. So we would have 2 lakh shares, right? Okay, so moving forward to next example, that is again related to stock dividend, and this example is necessary because the next question is somewhat dependent on this example. So the company with common equity account shown here has declared a 15% stock dividend and the market value is 35. What is the effect on the equity account will have on due to the distribution of stock dividend? So this is somewhat similar to the question that we solved 2 slides back. We need to find new shares outstanding. So the new shares outstanding would be equal to previous shares, old shares, multiplied by the amount of stock dividend. So how do we know how many shares previously we had? If the par value was 1 and the total amount was 4,06,000, then that means there were 4,06,000 shares. So 4,06,000, and we need to multiply it by 1.15, that is the amount of stock dividend. We would have 466,900. Next, we need to draw this equity account, and you know that the equity account would change because we have now each par value would remain same. Now we have total number of this new number of shares, so this common stock would be this much, and capital surplus would be 1340000 plus because the share price is 35, $1 is already recorded, and we are left with $34 multiplied by the new number of shares. So how many new shares are issued? Previously we had 4,06,000. Now we would have 4,66,900. So 60,900 new shares would be issued. So the total amount would become 3410600. Remember, the owner's equity would remain same, so we would adjust the retained earning, and now our retained earning would become right. This is the last question. Suppose the company instead decides on 4-to-1 stock split. The firm's 85% shares cash dividend on the new post split shares represent an increase of 10% over last dividend. So, so what this is saying is that imagine that company goes for 4-to-1 stock split, right? Second, the company also gave 85 cents of cash dividend. 85 cent is 0.85 of a dollar, right? So each dollar have 100 cents. Like okay, so 85 cents is cash dividend. So the question is saying that this 85 cents is 10% increase in the last year's dividend of pre-split. So what effect does this have on equity account? What was the last year's dividend? So what we need to find out is the last year dividend and the effect on equity account. So the equity account effect is quite simple. We know that in case of stock split, only this par value would change, and the par value would change by the ratio of, so previously for it was $1 and the ratio is 4-to-1, so the reciprocal would be 1-to-4, so the new par value would be 0.25. So this would only be the change in case of stock split. Next, what was the last year's dividend? To find the last year's dividend, we need to find the total dividend paid this year. So the total dividend paid this year will be the dividend amount times the number of shares outstanding, right? So the dividend multiply by number of shares should be equal to total dividend, right? The company had 4,06,000 shares outstanding before the split. We must remember that we need to adjust this shares outstanding for the stock split. So if previously there were 4,06,000 shares outstanding, so the new number of shares outstanding would be 4,06,000. We need to find out the number of shares, right? We know the dividend, it is 85 cents, but we do not know currently because this dividend is being paid after the stock split. So we do not know the number of shares outstanding after the stock split. So previously, if there were 4,06,000 shares, after stock splits, it would be 4/1. That is, so we need to multiply this 4,06,000 into 4. So this would be the new number of shares outstanding. Okay. So dividend was 0.85 multiplied by this new shares outstanding, and we would have the total dividend paid to the shareholders today, right? But the question isn't that how much dividend did we pay today. The question is that what was last year dividend per share. So we know if total dividend today is this much, and this was a 10% increase as compared to previous year. So what we need to do is we need to adjust this for that increase, and that would be, so if increased by 10%, so now previous year's dividend would be this much. But this is the total previous year dividend. We need to find the per share dividend. We know that previously total number of shares were 4,06,000. So we just need to divide the total dividend last year by the number of shares outstanding previous in last year, and we would know that last year the dividend was 3.09.